So, if you're trying to figure out how to invest over the next couple of years, you're going to need more than just a map. You're going to need a detailed blueprint. Today, that's exactly what we're doing. We're drafting a plan for building a truly resilient portfolio, one that's specifically designed to handle the bumpy ride we see coming in 2026. You can pretty much sum up the entire market right now with this one image. On one side, you have this incredible, powerful force of artificial intelligence, just lifting up huge parts of the economy. But on the other side, it's straining against this heavy, dead weight of a broader economic drift. We're talking inflation, tariffs, sluggish growth. It's a constant tug of war between these two massive forces. So that really brings us to the big question, right? In the world that's defined by these powerful, conflicting forces, how do you actually build an investment portfolio that's not just trying to survive, but is genuinely built to last for the future? Well, to get that answer, we've got to first understand the ground we're building on. And let me tell you, it's a little shaky right now. As the analysts over at JP Morgan put it, we should all be getting ready for a considerably bumpier ride. Let's dig into why that is. What's really fascinating about the economy right now is its shape. See, it's not a simple recovery where everyone's rising together. Instead, we've got what's called a K-shaped expansion. The top arm of that K is soaring upwards. Wealthier households, they're doing great, benefiting from market gains and spending big. But that bottom arm of the K, it's heading down. Lower and middle-income families are really feeling the squeeze. And that unevenness is getting hit with some serious headwinds. For one, you've got higher tariffs, which could mean things just get more expensive for all of us. Then there's slowing job growth. That's a huge engine for the economy, and it's starting to sputter. And inflation? Everyone's hoping it'll just cool off, but it might get a little volatile first. When you add in the fact that the economy's overall momentum is pretty modest, and the Federal Reserve can't seem to agree on what to do next, well, you've got a perfect recipe for uncertainty. Okay, so with all that uncertainty, how do you even start to build? It's simple. You start from the ground up. The very first step in our blueprint is to pour a rock-solid foundation, something that secures your portfolio's base with assets built for stability and income. So when we talk about your foundation, we're talking about stuff that's all about stability and predictable income. Things like high-yield savings accounts and CDs. They're FDIC insured, so your money is safe. Then you have short-term treasury ETFs, backed by the full faith and credit of the U.S. government. They're also super easy to sell if you need cash fast. And finally, medium-term corporate bond funds can give you a little extra income while still being a really strong defensive part of your portfolio. And, this isn't just our idea. The experts at JP Morgan really hit the nail on the head here. They say to embrace income and focus on active security selection, which is just a fancy way of saying be picky about the bonds you buy. The bottom line is, when the market gets choppy, that steady income from your foundation, that's your portfolio's anchor. All right, with that solid base poured, it's time for the exciting part. Now we get to add the engine that's really going to power your portfolio's growth for the long haul. And for most of us, that engine is going to be the stock market, topped through diversified index funds. An S&P 500 fund basically gives you a small slice of 500 of the biggest, most successful companies in America. Think Amazon, Berkshire Hathaway, the whole crew. If you want to get a little more focused on innovation, a NASDAQ 100 fund zeroes in on the biggest tech players like Apple and Microsoft. This is what drives you forward. And the fuel, the high-octane fuel for that growth engine right now is, without a doubt, AI. I mean, just look at these numbers. The amount of money the big cloud companies are pouring into AI infrastructure it's just astronomical. It's projected to blast past $500 billion in 2026 alone. This isn't just some passing trend. It's a fundamental rewiring of the entire economy. But whenever you see that kind of explosive growth, it brings up that huge trillion-dollar question. Are we looking at a speculative bubble that's about to pop? Or are we in the early days of a genuine long-term boom? And honestly, there are good arguments on both sides. The folks in the bubble camp will tell you that valuations are sky high and that way too much of the market's gains are concentrated in just a few giant stocks. But the boom camp has a pretty powerful comeback. They'll say, look, unlike past bubbles, this one is being paid for by incredibly profitable companies swimming in cash, and it's meeting real demand from customers who are actually paying for these AI services. So, what's the final verdict? Well, JP Morgan's analysis comes to a really interesting conclusion. They say this whole thing looks less like an empty bubble and more like the tumultuous beginnings of a structural transition. And for any long-term investor, that is a really key distinction. All right, foundations in, engines running. But what happens when an earthquake hits? Every good building has to be able to handle a few tremors. In a portfolio, that means we need to install some shock absorbers, the assets that keep you standing when the market starts to shake. And the classic shock absorber is what we call a safe haven asset. It's exactly what it sounds like, an investment that tends to hold its value or even go up when everything else is going down. The textbook example, of course, is gold. And look, this isn't just some old school theory. The data is absolutely wild. Just check out this table. During huge crises like Black Monday or the global financial crisis, times when the S&P 500 was getting crushed, down an average of 22%, gold did the exact opposite. It was up an average of 11.5%. That is a perfect picture of a real portfolio stabilizer in action. And it's not just about playing defense. It can actually juice your overall returns. This analysis from Standard Chartered is fascinating. It shows that just adding a 15% slice of gold to a model portfolio boosted annual returns by over 3%. That's the power of having something in your corner that zigs when everything else zags. But hey, gold isn't the only tool in the shed here. Another really key diversifier is international stocks. For what feels like forever, the US market has been the only game in town. But as JP Morgan points out, that earnings gap between US companies and companies overseas, it's been shrinking. Other markets are getting way more competitive, and that gives you another great way to balance things out. All right, so we've looked at all the different parts. Now, let's put it all together. Let's build our final blueprint, your actionable plan for the future. Here it is, boiled down to 4 simple steps. Step 1, build that strong foundation with safe, income-focused assets. Step 2, fuel your growth engine with those diversified stock funds. Step 3, add your shock absorbers like gold and international stocks to handle the bumps. And finally, step 4, balance the whole thing to make sure you have true diversification. You know, for a long time, it felt like all you had to do was own a handful of US tech stocks and you were set. But as JP Morgan says here, diversification isn't dead, it's just different. And right now, this very moment marks an excellent time to get your portfolio back on sides. Which really brings us to the final thought I want to leave you with. The landscape is changing, the ride is going to be bumpy, and the old playbook might not cut it anymore. So the real question is this. Take a hard look at your own strategy and ask yourself, is my portfolio truly built to last?